Hello my friend, welcome back to another video with the Meditative Investor. And in this video we're going to be discussing my profit and loss statement, specifically with my options trading. Just started back in November, so I have this platform I'm going to show you, and I'm also going to show you at the very end of the video, towards the end, an option strategy that I've been using during this 100K challenge. By the way, if you're new here, by all means hit that subscribe button if you want to see all things investing, and of course in a meditative fashion. And also go ahead and hit that like button because it helps the channel grow, gets this video out to more people that would like to see this type of information. You ready to dive in? Let's go. We're going to open up my Tibio account, and Tibio is a platform that I use to track my options. You can track your credit spreads, you can track your single vertical options, puts and or calls, and also track just regular stock. Okay, so I have a link below if you want to join Tibio. I think it's like free for 30 days, and then it's $24.99 a month, I think, and then a 30-day money back guarantee if you don't like it. So I like it. So let's go ahead and show you here. Average total of 47 trades, as you can see that I've listed. I haven't got them all on here because I started back in November, and I just got this like end of December. So I'm still adding stuff in, so the numbers may not be super accurate, but it's almost kind of accurate. So as you can see, 62% wins, awesome. Average win is $100, sweet, and losses 38%. My average loss is around $50. So commissions are zero because most of my options that I log on here is from Robinhood, commission-free platform. Link in the description below to join Robinhood. And you get a free stock and I get a free stock if you use my link. As you can see, my profit and loss is $7,757. Pretty good. So let me go ahead and show you real quick of the Tibio platform here. Let's go to my trade board. So my trade board just shows you pretty much all of the trades, the companies that I've used, the symbols that I've traded. As you can see, the P&L, red mean I lost money, green mean I made money. And right here, positions is another one that lets you know what I have open here. So I have 4 contracts here, 5 there, 2 there, 2 there, 10 there, and 1 there. So that's everything that I probably have open on my Robinhood account. And we'll go over all this other stuff here later, but I want to dive into the actual strategy that I use and the options. Okay, so in this particular video I'm going to show you credit spreads. Okay, now let me break down that word for you. Credit, as far as investing goes, means you are receiving income. You're receiving a credit. That means money is getting deposited into your brokerage. Okay, a debit means money is taken out of your brokerage. Okay, so we got that figured out. The spread part means that the credit that you are receiving is the difference, is the difference of the spread of the strike price of the option that we're going to choose. You feel me? So credit spreads, that's what we're going to be doing, and I'm going to show you specifically in this video put credit spreads, which I've talked about in other videos, but I'm going to go through step by step and show you how to set up a put credit spread. All right. So for this, let's not use Tesla. Let's just use the S&P 500 index. It's very liquid, very awesome to use for credit spreads, for beginners for sure. So what you would do, number one, is just kind of take a look at the chart, kind of see support and resistance, and see how the chart has been trading over the course of weeks, the months, maybe 3 months out. You can kind of see we're on this bull trend here. So then you will go to trade options. Up top you will have different expiration dates. Okay, so the expiration dates are pretty important. The S&P 500, you have 3 expiration dates per month, so you can potentially get paid 3 times per month. Now the tricky thing with this is that if you do it too short, then you don't have too much time to manage the trade, really, to kind of allow time to be on your side. Things can change quickly, but so if you get a further out expiration date, then you have a little bit more time to where you don't freak out so much so quick. Okay, but for this explanation, we're just going to choose January 22nd, which is this Friday. And what you're going to do is you're going to hit the date, you're going to hit sale, and then we're going to go for a put. Okay, a put credit spread means that you're bullish on the stock. That means you want the stock price to stay above the strike price that you're going to sell your put at. So for a credit spread, you are going to be selling a put and buying a put at the same time on the exact same expiration date. Okay, first thing you want to do is sell. So the closer you are to the share price, the more you can make. Okay, because it's a little bit more riskier. The further away you are from the share price, the less you make, but your probability of winning is a little bit higher. As you can see here, chance of profit, further you go down, the higher it gets. Okay, so just for this example, let's go to an 81% chance of profit. I like those odds. So what you're going to do is you're going to hit select at the top right corner. You're going to hit the 367. We're going to sell the 367, and then what you're going to want to do is hit buy. Now here's where things get interesting. The spread can be $1, as you can see, 367 and 366, or $2, $3, $4. And the wider the spread, the more credit you receive, but the higher your collateral. And I'll show you what I mean by that. Let's go to 366. You hit review. As you can see, you will receive a $14 credit into your account. You will hit 1, review. The collateral is $100. So you'll be putting up $100 to receive $14, which is around 14% profit. Freaking awesome, right? So if you want to get a higher one, let's go back. And we're going to make the spread a little bit wider. If we go out $3, you can be making $36. But the collateral now is $300, you see? So the way they get that number is you take the difference between the strike prices, 37 or 367 minus 364, you get $3. 3 times 100, because when dealing with options, each contract is worth 100 shares. So 3 times 100 is 300, and that is your collateral. Okay, and that's pretty much what a put credit spread is. So if the S&P 500 closes above 367 by this Friday, you keep the full $36 and your collateral gets brought back to you. If it drops below 367, then you have the potential to lose all $300 of collateral, but you keep the $36 regardless, so pretty much you have lost $264. Okay, that's what a put credit spread is. That's pretty much it, guys. And in another video, I'm going to show you what a call credit spread is, just not in this video. And I have made some money in put credit spreads, and I have lost some money in put credit spreads, mainly because my emotions got the best of me. But at the end of the day, if I would have let it go all the way to the expiration date and expire, I would have pretty much kept all my money. It's just your emotions sometimes can get the best of you. That's why continuously I'm going to teach here, have some sort of meditative practice to keep your emotions in check. Okay, it's gonna be tough. It's gonna be a learning experience. Trust me when I tell you this. The stock market can really rile up those emotions because it's your money at stake. Okay, so that's pretty much all I have for you in this video. Hopefully you enjoyed it. If you did, hit that like button for me. Comment below. What positions are you in right now? Have you ever done options? Have you ever done any credit spreads? If so, let me know what's your favorite stock to do it on. Let's go ahead and have a discussion in the comment section. And also share the video with any family members that you may think that will be interested in this kind of information. Okay, so blessings, mahalos, later.